required. Taxable income for Royce Rubadi for the year ended, that was December 2015, and the tax payable, if any, by Royce Rubadu. This is a case of incomplete records, and whether or not somebody is maintaining proper records or you don't maintain proper records, tax has to be paid. Now, we have Royce Rubadi, computation of taxable income, for the year ended, that first December 2015. So we have particulars and we have shillings. Now, because this is a case of incomplete records, we are supposed to start with the incomes, the taxable incomes, and we less the allowable costs. Now, the first major income that we are supposed to start with is sales. And the sales that we are supposed to include here is both cash sales and credit sales. The two sales are taxable. In my question, under the cash book summary, I have cash sales of 1620. But for the credit sales, I have to do a working, so I will prepare working one so that I can get that credit sales. So working one here, calculation of credit sales. In order for us to calculate credit sales, we need to prepare receivables control account. For the receivables controls account, we will put the balances and any other item that affect this particular ledger. So we start with balance brought forward. Balance brought forward for the receivable is 781,000. Balance carried down for this particular account is 821,400. That is it. And what we are looking for is credit sales, and therefore this will be the balancing figure. It's a figure that we are looking for. So let's put any other item that affect this particular ledger so that we can get now the credit sales. In my cash summary, I have amount received from the debtors. So amount received, and this amount received is 1,226,200. 1,226,200. Then I can move to additional note number 1. I have discount around. Discount around reduces the credit. So discount around. Discount around is 5,600. Then from there, note 2 drawings, note 3 depreciation, note 4 we have bad debts. Bad debts reduces the debtors. Bad debts written off. Bad debts written off 72,000. And those are the only items that we have which affect the data. Therefore, we need to do the calculation and we calculate these credit sales. Now, the credit sales will be 1,226,200 plus 5,600 plus 72 plus 821 400. So you get the total here is 2,170,200. 2,170,170 200. I subtract 781,000, 781, not 781, 781,000. I get 1389,200. That is the figure for the credit sales. So 1,389,200. Then I get total sales. Total sales plus 1620,000. You get 3,009,200. Then from there, you less cost of sales. For the cost of sales, we start with opening inventory. Opening inventory. The opening inventory in our question is under the balances. Opening inventory 1241,600. 1241,600. Opening inventory. Then you add purchases and purchases. Purchases you are supposed to add for cash, add for credit. In the cash book summary, that is where we are supposed to get the cash purchases, and I can see it as cash purchases 1620, 800. 1620, 800. Then for credit purchases, we need to do a working. So we have working 2, calculation of credit purchases, calculation of credit purchases. This one, we draw the payables, control accounts, debit, credit. This is a liability account, so the balance is on the credit side. So balance brought forward for the payable is 985,000, 985,000. We can also put balance carried down, which is how much? 1180,000. So 1180,000. What we are looking for is credit purchases, and this will be the balancing figure. This is the balancing figure now. Let's put any other item that affect the creditors. In the cash transactions, we have payment to creditors. So amount paid. The amount paid to creditor is 1,005,200. Then we have note number 1, discount received. Discount received from the creditors is 151,200. Discount received. Then any other item, we do not have any other item that affect the creditor. So we balance out the account, we get the credit purchases. So I add 1,005,200 plus 151,200 plus 1180,000. So we get 2,336,400. 2,336,400 minus 985,000. You get 1351,400. So 1351,400. 1351,400. Then from there, after we add the purchases, we less drawings of goods. Drawings of goods is also there, is given. Note number 2, goods withdrawn 100,000. The other item that is affecting this is closing stock. You also less closing stock or inventory. Closing inventory is 1480, 600, 1480, 600. Now we don't have any other item that affect that, so directly we can move to cost of sales. So what is cost of sales? This will be 1241 600, 1241 600 plus 1620,000, 1620 800, 1620 800 plus 1351 400 minus 100,000 minus 1480 600, 1480 600. So we get 2,633,200. From there we can get the gross profit. Gross profit now, we have 9,200 minus that answer, you get 376,000. Then you add any other taxable income and other taxable incomes. Other taxable incomes that we have in my question here, we have only the commission received. Commission received. And for the commission received, we also have an adjustment. The commission received is 124,000. Then under the summary of assets and liability, we have commission received in advance. Commission received in advance, as at start, it means we received it so that it can be utilized this year. So you earned. So plus 80. We less commission received in advance as at the end belong to next year. So minus 136. So the commission now for the year is supposed to be 124 plus 80 minus 136. You get 68. And that is the only, no, we also have discount received as another income. Discount received. And the discount received still is another income. Note number 1, 151,200. 151,200. That is, those two, they are the other incomes that we have not captured in that case. So we get now gross taxable incomes. Gross taxable incomes. This is equal to 376,000 plus 68,000 plus 151,200. You get 595,200. From there, you raise the allowable expenses. We raise the allowable expenses. Let's continue on this end. We less the allowable expenses. Less allowable expenses. For the allowable expenses, let me start with the additional information. Additional information number 1, we have discount around. Discount around. Discount around is 5,600. 5,600. 50,000 and 600. 5,600. Then number 2 drawings now. Number 3 we have capital allowances. That one we need to consider the assets that we have. So WTA. So we have 2 assets, that is motor vehicle and furnitures. So we talk of here WTA on the first one is motor vehicle. Motor vehicle. And for this motor vehicle, what we are supposed to do, we are supposed to take the rate, which is 25%, times. We have the value of the motor vehicle as at start, which is 960, plus any motor vehicle that is bought. We bought a motor vehicle from the receipt and payment of 600. So this is the value of the motor vehicle that we had as at start, plus what was bought, so we calculate wear and tear. Then we will also consider furniture. For furniture qualifies for wear and tear class 4, so 12.5 or 100 times. For furniture, we are not buying other furnitures. So it's only the furnitures that are existing that will depreciate. So we just multiply here by 120. So 25% times into brackets, that is 1560. 1560. You get 390,000. The other one is 12.5% times 120,000. You get 15,000. 15,000. Now the other one is we consider the other item that is depreciating. So note 3 we are done. Then we have bad debts. Bad debts normally they are allowable. Bad debts. And bad debts here written off is 72,000. 72,000. Bad debts, specific bad debts, they are allowable. Then we can move to the receipt and payment. The payment side, we check for more expenses. The first expense that is allowable there is salary. This salary, we have a note under the balances. So the salary is paid. It is 16,400. That is the salary paid. 16,400. Then we have salaries due. So salary due we add as at the end. So plus accrue as at the end plus 150 minus as at start 184. This will add up to 16,400 plus 150,000 minus 184. You get 16,26,400. The other expense is rates and insurance. Rates and insurance. The rates paid is 320.8. 320.8. But for rates we have prepayments. For prepayment we add as at start, so plus 50 minus as at the end 72. This is not for this year, is for next year, so we less. So 320,800 plus 50,000 minus 72,000. You get 298,800. The other expense is medical bill self, not allowable, but transport is allowable. Transport. Transport cost 56,400. No note. Bank charges, they are allowable. Bank charges, they are allowable 3,000. Then general expenses, they are allowable. General expenses, they are also allowable. No note. 145,400. Loan interest is also allowable. Loan interest. Loan interest, we are not given the amount of the loan, so this means it is equal to the actual interest that is supposed to be paid, 120,000. And that then discount allowed I captured, so that is it for the expenses. So I get now total allowable expenses. I have 5,600 plus 390,000 plus 15,000 plus 72,000 plus 1626,400 plus 298,800 plus 56,400 plus 3,000 plus 145,400 plus 120,000. In total, this is 272,777,600. So you get taxable income. Taxable income for the year. Taxable income for the year will be equal to now 595,200 minus 2,777,600. You get a loss of 2,182,400. This is a loss. So this is a taxable loss. Taxable loss. For the loss, we put it in bracket. We put it in bracket. And therefore, that constitutes the taxable loss for the period. That's how we address those 10 marks. Roman 2, we are supposed to get tax payable if any. And in this particular case, we are saying there is no tax liability for Roman 2. No tax as the business reported a loss. If a business reports a loss, that loss can only be carried forward and be offset against future income from the same line of a business.